So I guess the talk of the town is just going to continue to be interest rates, inflation, jobs market. But here, I just want to ask you guys a question. Like seriously, like let's just talk about something. We are in inflation. We could probably list what they are. Number one, we get shut down and the government prints an enormous amount of money, gives it to small businesses, people. It just went everywhere. Like $6 trillion, whatever the number is, it landed everywhere. Everybody got a piece of the pie, right? People don't have to pay their bills, all this stuff. Then we get locked up. Then we come out, then it's the big old party, have a good time. But here's the thing, is that we thought inflation was gonna come and go, it hasn't. We thought inflation would maybe come down because supply chains, is that really what it was? But here's what I don't understand. We have a government that clearly says they're gonna take in $4-something trillion. They need to spend $7-something trillion to keep this thing going. So as I will ask you, as I always have this question and conversation in my own head is, where is inflation coming from? The government won't cut rates. It's the feds because they don't like the inflation reports. But aren't we still in an inflationary environment because the government is the biggest hirer? Because they're still spending money, folks. They are still spending money and giving money. I guarantee you there is a plethora of money being given to people that should. We're forgiving student loans. We're giving money to programs, right? All this stuff. They're trying to stimulate the housing economy. They want to give money to people to go buy a house. This stimulates. This is what you do when like inflation is down, I thought. So I just am concerned is the Fed going to have to go from 2 to 3%? Like what are they going to do here? Because at some point, everybody knows, Democrats, Independents, and Republicans, they all know, they're all part of it. Every friggin' American knows that we spend more than we bring in. We know we're 30-something trillion in debt. We are all aware of it. It's a number and it doesn't lie. We all know we have a spending problem. We get it. If you're going to continue to have a spending problem, aren't you going to have an inflationary problem, right? Because I know before we were spending prior to 2019 and giving money and keeping rates low. But what about all the programs that were started during the pandemic, during COVID? There were so many of them. You're telling me all of them are gone? That they're not giving any free money out, any free lunches out? I just find it hard to believe. So I just sit here and wonder, what's going to give here? Are we going to stop spending the money that we don't have? Are we going to just move the goalpost with inflation? Are we going to accept that this really maybe isn't that inflationary as we think? Because if you took the government, like why don't we take the government spending out and the government hiring jobs, just take that out. Where do we sit? So the reason why I'm having this conversation is because everybody in real estate, they want the lower rates, they want this, they want that. And it's really coming down to, you can't make sense to refinance stuff because of debt. You can't make sense to buy stuff because of debt. You can't make sense with credit cards, with business lines of credit to start a business. Like nothing's making sense, but it makes sense to spend $7 trillion, we take in $4 trillion, but let's penalize everybody else. So I think there's some questions that need to be answered here and we don't have the answers to them. So it's very confusing and I'm tired of having this conversation with so many people because it's like, when are we gonna pivot? When is this gonna happen? When are we gonna stop spending all this money? But we can't, you just have to make a decision. If you don't have the money, you just have to stop. That's why I say at the house, like if business, if you don't have it, you gotta cut. At house, you don't have it, you gotta cut. You got to cut somewhere. It's time to start cutting, but nobody wants to talk about cutting. But what we do want to talk about is how great the job market is, how robust the economy is, and how inflation just won't die. But we all know this is really coming down to the government spending, I think, is keeping us alive. That's what I'm talking about. What if we just cut a bunch of stuff and went lean and mean? Do you think we'd have the same economy as we do now? And I just don't think we do. I could be completely wrong, but government spending and hiring and all the infrastructure and all this stuff they're doing is making a huge impact on this economy. It's probably keeping the economy alive because we can tell you right now, they're not talking about, hey, why don't we make rates lower? Why don't we, work on the spreads, bring those rates down? Let's just give people money to buy a home. I thought we had a problem, a housing shortage, so you want to encourage more people to buy homes with higher rates, less affordability, and kind of an economy, honestly, to me, is that at some point, something's gonna give. What's gonna give? I don't know. Something will give, and when it gives, rear its ugly head of what we're gonna deal with, because it ain't gonna be roses and sunshine. There is no way it's gonna be roses or sunshine. But anyways, welcome back, everybody. That is my rant. It's not a rant, it's a conversation we keep having day after day, week after week, month after month in this business. It's really frustrating. And if you're listening to this and you're frustrated, trust me, I'm frustrated too, because I want to talk about pivoting and changing and let's move on. But this thing is dragging out forever. The government is just, when are they going to stop spending money? Because it would just be nice to know. Why don't you guys tell us that? When are you going to have a balanced budget? That's what we want to know. Because a balanced budget would make a huge difference, I guarantee you, in the job market, in the economy, and everything else. Because you cannot keep printing money at this pace. At some point, the debt, we're gonna have $1 trillion of just interest that's coming up when we refi. Just so you guys know. Like, so now the 4.7, it's just gonna keep going. But anyways, welcome back to another episode of The Brief. If this is your first time here, I apologize for the rant, but you might be feeling the same way. If this is your 10th time, 20th time here, welcome back. If we've never met, my name is Kenny Simpson. I focus on 1 to 4 unit financing, whether you're a first-time home buyer, whether you're a real estate investor, you're self-employed, whatever it is, I'm here to help. Been doing this 20 years, helped over 5,000 clients. I have to mention this because some people actually watch my stuff. They don't know what I do. So that's what I do. If I can help you, if you get this lovely email, just go below, book a call, text me, email me, come by my office, whatever it is. Love to chat, love to answer any questions I can, help you out. But it's time to move on. It's time to go into the data, because the data, unlike the feds, it never lies. Only when they give us a bullshit jobs report that they have to revise. But if they just waited to give us the good stuff, it wouldn't be bullshit. What is going on with interest rates? Well, it was back to my earlier statement. When we get bad jobs reports, when we get Fed officials that want to say dumb shit, when we want to get a pal that doesn't want to cut, when we want to get a government that wants to spend, when you just want to get a bunch of crap that makes people insecure, not confident, you get a higher 10-year treasury, you get higher rates. The good news is the spreads got a little bit better, but look, I look today, you're probably looking at a 30-year fixed, no points, high 6s, 7%, somewhere around there. So nothing great. It's not like it's 8%, but look, rates are what they are. The 10-year treasury is at 4.4 today and change. It broke the threshold of 4.35. It's a tough week. We've got CPI, Fed's talking, so it's going to be bumpy. We either end the week probably with the 10-year closer to 4, or we're going to end it with the 10-year probably above 4.5, depending on the data we get. I might be wrong, but I'm just throwing it out there, trying to give you guys something, just something. But I could be wrong. It's just a guess, just trying to have some fun. You know, I don't know about you guys, but I'm hearing it's happening to clients, it's happening to other people. People that have great jobs are being laid off left and right. Listen to a podcast, 275,000 people have already lost their jobs this year. So good jobs. A lot of tech workers, salespeople, companies repositioning. So the job market's definitely shaky. Good people are losing their job, having to find another job. So it's going to be very interesting, but there's some big layoffs and other people are hiring. AI is obviously probably a big hire. So a lot of people that were going, this engineer going over to AI because you can, but very interesting out there. Very, very interesting. And somebody mentioned that the unemployment number would have to be above 4 to get the first rate cut. That was Danielle DiMartina Booth. I don't know if she's right. She's a very intelligent lady. She's been on the podcast before, which I should probably get her back on. But anyways, so we have to see if that happens or not. But it would be interesting. The other thing is that talk is how are we not going to have a recession? How are we going to have a soft landing? How are we not going to have with all this money, all this stuff? The real estate market's starting to, crack and crumble, people giving back properties. So I feel like this booming economy is really just dragging on, and there's this recession lingering over here. There's a booming economy and a recession lingering, and those two things, together, where's the ending? And I sit here and I think, like, if we get more unemployment, which naturally happens, less people pay their bills, less jobs. I don't know. It's hard to say if we're going to have a recession. Kind of all over today. It's like Monday after the spring break and kind of feeling all over the place. But I don't know. I don't know if we're going to have a recession. It would definitely help rates. It's not going to help other things, but it hopefully reset some prices. But I don't know. It'll be very interesting. But a lot of people still think we're going to have a recession. Some people think we're in a recession. Some people think we're just going to wake up one day. Things are going to correct and not necessarily fall off a cliff, but we're going to feel the pain. And it's coming. It's just lagging. And a lot of people blame it because the government keeps spending money, as I just mentioned. Here's a fun little article. that I'm going to chat about recently, CNBC, the big money blind spots you need to avoid. I thought this was a cool article. I'm like, we talk about money here. We talk about buying a house, which is most likely your biggest purchase. And why not talk about, hey, blind spots you need to avoid? Number one, credit score. Your credit score can range from 300 to 850. Obviously, your credit matters. If you have a lower score, you are going to pay a higher rate. You most likely you couldn't get a credit card. You couldn't probably have problems with student loans, with a business loan, with a mortgage, even getting a car loan. So credit matters. Pay your bills on time. Keep your balances 50% low if you can. And just don't miss payments. Don't co-sign for anybody. I know you want to, but make sure that you can make that payment if you co-sign, because so many people get screwed. Watch out for those parking tickets, medical collections, all that can really screw up your credit. Wills, essential for estate planning, dictating who inherits assets and takes care of minor children. Without a will, state courts decide. You definitely do not want your state court to decide what happens if you die to your kids, the money, your properties, all that. So 2 is get your will figured out. Number 3, big one. We learned a lot about this during the pandemic, that the average person or whatever had not even had $500 in the bank account saved. It is emergency savings. Savings needs vary. Single individuals and certain couples should aim 3 to 12 months of expenses saved, depending on job stability and income sources. Saving is huge. I always recommend is when you get paid, have money get transferred to an account that is a pain in the ass, a nightmare to get to. Like you almost have to walk in the bank to get the money out of. That way, you know it's out of sight, out of mind. It's like paying a bill, and that money is there for a reason. It's an emergency savings. Tax withholding. Workers need to adjust withholding based on life events to avoid owing too much or getting large refunds. Aiming for tax efficiency. Tax withholdings, I mean, that's something you need to talk to your CPA about. If you're obviously self-employed, you want to pay in, but a lot of people self-employed that become self-employed forget that you got all this money, then you show net income and then you have to pay taxes. If you're W-2'd, maybe don't take too little, don't give them too much, figure out the balance, meet with your CPA, your accountant, and ask them strategies. If you don't have a CPA, you file yourself. Well, go online, do some research and figure out what's the best for you. But it is smart to do your tax withholding and know what you're doing. And last but final number is retirement savings. People often underestimate retirement spending. Needs planning should include lifestyle and potential long-term care expenses. I think to be comfortable, there's an article written, they need $1.7 million in the bank. Not sure what age that is. I'm guessing that's if you're getting Medicare, Medicaid, all that stuff. Maybe you're getting Social Security. I don't know, but that's what it is. Those are the money blind spots that you should be paying attention to. Okay, here's another article by the New York Post. California's housing slump spells trouble as the state is set to get even more pricey. Yeah, guys, you know what? I don't even have to read it, but I will. Let me guess, it has to do with development, and development. Well, let's see what it says. I got 4 bullet points. California real estate slowdown. A decrease in home construction is causing concerns in the industry. Shocker. Number 2, impact on housing prices. Limited housing supplies could lead to even higher prices, worsening the state's affordability crisis. Sounds like inventory problems. Number 3, Ken Kayens challenges the president of the California Landmark, sorry if I screwed up your name, group, known for luxury apartments, is facing tough times as he scaled back on projects. That's probably because rates are high. It's a nightmare to build. It's expensive. And also when you have to go get debt to build and you're paying 10, 11, 12% to build, it makes no sense. You'll just put your projects on hold and just wait, because what do? Is there any incentive from the state to build? Is he getting any support? I doubt it. Oh, what do you know? They're just going to stop building apartments, so that will only cause rent to go up in the next few years because debt's high. It's a pain in the ass. So when rents go up in 2-3 years, you're going to want to thank all these lovely cities for not making it easy to build stuff. And last but not least, widespread development struggles. Developers in California and nationwide are encountering increased difficulties due to rising labor and material costs, plus strict regulations, and I'm going to add one in there, interest rates, and also to even get a construction loan is hard. So It's very hard. Guys, we're going to continually have problems in places like San Diego and California if we cannot figure out how to build, cannot get support from local governments and people. We need it. Rent control is not a solution. Blaming landlords is not a solution. Even blaming the politicians, the city is not a solution. We need to come up with solutions and quit talking about the problems. Solution is maybe help builders build more affordable housing. Maybe give them big incentives. Maybe rush them through the permitting process. Let's get the ball rolling. Let's talk intelligently, but we need the housing because it's causing major issues. I love this article by Wall Street Journal. Listen to this. Insurers are spying on your home from the sky. Are you kidding me? They came out with a recent article that all the data in your car when you drive, you think you're driving down the freeway like a race car driver, or you slam on the brakes hard, you take off quick, you accelerate. Your car is logging all this data. That data, just so you know, folks, gets shared, yes, with your insurance company. So if you get a bill and your insurance goes up because of your car, that's maybe because they have the data that you think you're a race car driver and they want you to drive like Betty Boo, your grandma. So anyways, here we go again. They're spying again. In this Wall Street Journal article, let's go into, I got 4 points to go through. Cindy Pico's insurance dropped. Pico's from Northern California lost her home insurance based on aerial photos indicating her roof was beyond its life expectancy, which she disputed. Oh, wow. So we just have Google or fly drones over now? Okay. Insurer's refusal. Her insurancer wouldn't share the photos or reconsider their decision even after an independent inspector supported Pico's claim of the roof not having 10 more years life. Wow. I guess a roofer on the roof is not as good as a drone flying over, but sounds like they just are making excuses not to insure properties. Widespread use of aerial imagery. Insurance companies across the U.S. are increasingly using aerial photos to identify properties they consider higher risk for underwriting decisions. And last but not least, surveillance techniques, drones, airplanes, and balloons are employed to capture images of nearly every U.S. building, often without the owner's knowledge. I don't know if this is legal. I don't know not, but we're going to keep going on. The industry's group airplane imagery program claims to cover 99% of the U.S. population. Criteria for dropping coverage. Photos are analyzed to identify potential risk like damaged roofs, yard debris, undeclared features, e.g. pools, trampolines that could lead to insurance being dropped. So if you have a trampoline or a pool, they could drop your insurance. What in the hell is going on? Consumer reports. There's a significant increase in consumers being dropped by their insurance based on aerial images analysts, as noted by Amy Batch of United Policyholders. The trend reflects insurers' efforts to de-risk their portfolios by eliminating coverage for homes that don't meet certain conditions, aiming to recover from substantial underwriting losses. So it sounds like they're just trying to find excuses to get rid of you, to not insure you so they don't have any more losses. So kind of sounds a little fishy. And last but not least, at Wall Street Journal, for all you first-time home buyers, here are the 6 new rules of home buying in a changed market. Let's get into them. Real estate agent commissions changing. Traditional sellers paid commissions 5-6% for real estate agents to be more negotiable after a legal settlement. Look, Washington's already doing this. Still 92% of sellers are paying those costs. So we might not agree with this list, but let's go through it. So it's all negotiable. Number 2, new payment models for agents. Buyers might need to pay their agent directly, possibly impacting first-time home buyers. Of course, maybe the seller does not want to pay. So maybe you don't buy that house if you don't have the money. So it's all negotiable. It always was negotiable. So if you're a buyer, you're going to sign a contract. And if they don't get paid by the listing agent, you have to pay them. Of course they need to get paid. This is a job. They're working for you. So that is what it is. But I think that one's okay to me. Average 30-year fixed rate mortgage is at 6.74. Shopping around could offer slight rate reductions. Absolutely. Shop around, use a mortgage broker. They should be doing it for you, but shop around, try to get the best rate, service, knowledge, all that stuff, because it's not just about the lowest rate. Because if you have a complicated deal or something comes up and you went with the lowest rate and the service is okay, you might regret that decision. New construction appeal. New construction represent 32% of home sales, with builders offering incentives. However, buyers should still conduct home inspections. Absolutely. Builders are winning because they're buying down that rate. They're getting their in there and they're beating the competition because their margins look very healthy because they have a lack of competition. Planning for dual transactions. Those looking to buy and sell simultaneously need a financial plan to bridge potential gaps between transactions. That's where a bridge loan or, buy before you sell. There's all these programs to help people out because they realize there's no inventory. So you're going to see many, many programs out there. If you have questions about this, concerns about timing, this, that, look, book a call with me or my team. We can help you out. We can go through those questions, get them answered, but we're always here to help. With that being said, folks, that is it for the brief. Thank you for watching. I hope we'll get some more exciting news soon, but I'm looking out the window in this beautiful sunny San Diego day as we approach spring and summer. So let's hopefully get some lower rates. We get some more inventory. And so help some of you home buyers get into homes and home sellers. 40% of you are new home buyers, I believe, something like that. So anyways, thanks for watching. If you have any questions, reach out. Talk to you soon. Have a great week. We'll keep watching the rates, the data, all this fun information, and we'll circle back around to you next week and let you know what is going on.